This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the fourth of 5 videos on wedges. I want to start by talking about parabolic wedges. A parabolic curve is one that increases in its slope as it progresses. It's a type of a biclimax if it's a bull wedge. It's a type of a sell climax if it's a bear wedge. Also, strong trends always have bad-looking wedge reversal patterns. When I talk about a parabolic wedge, the wedge often does not have much of a wedge shape, but it does have 3 pushes. It's 3 consecutive biclimaxes. Here is the first push. You can say it's this 1 bar or these 3 bars, and then this second bar, and then that third bar. First push up, second push, third push. 3 pushes, so it's a wedge. Very tight channel. When it's a tight channel like that, I usually refer to it as a parabolic wedge. If it occurs at the start of a session, it's more likely to lead to a reversal. The third push here, subdivided. We had a first push, and then a pullback, and then a second push, and then a pullback, and then a third small push, and then a reversal down. You can call it a nested parabolic wedge. You can see the tail on the top of this bar, on the top of this bar, on the top of this bar, and here as well. Every time the market's going up, instead of finding new buyers, it's finding sellers. There are often gaps. The legs don't overlap. Second push up, the pullback from the second leg did not overlap the top of the first leg. There's a gap. The channel is very tight. I'm drawing an approximate channel here, but it's a very tight channel. On the way down, the same thing. A first push down, a pause, a second push down, a pause, and then a third push down, so 3 pushes down. I would call this a parabolic wedge bottom, and we got a reversal from it. The curve may or may not be parabolic. For example, this bull parabolic wedge is not parabolic. However, the bear parabolic wedge, if you draw a line connecting point 1 and point 2, and then another line connecting point 2 and point 3, the second line is steeper. So the downward slope is increasing, and that's why I use the term parabolic. You can see point 1, point 2 here, or point 2 here, and then the third push, it's steeper. Third push often breaks below the bottom of the channel before reversing. I could have drawn the line here connecting point 1, point 2, point 3, and the third breakout fell below the bottom of the channel and then reversed. That's another way to document how it's parabolic, how it's increasing its velocity downward. Anytime you have a parabolic wedge or a parabolic series of biclimaxes here, 1, 2, 3, or sell climaxes, 1, 2, 3, you have to be thinking that the market has gone too far too fast. The stop is too far away. Traders have to take profits. Aggressive traders will sell a bull parabolic wedge or buy a reversal up from a bear parabolic wedge, betting on at least a small profit. Most traders should be very cautious and hesitant about taking these trades, and only take them if you can manage them well. For example, if you're selling below this bar, or better, below this bar, you want to make sure that you can rely on a stop up here, and you can sit through attempts at trend resumption here and here. If you take the first entry, entering here, your stop is up here, the risk is small, but so is the probability. If you wait until there's a strong breakout, a pair of consecutive bear bars, you have a higher probability of at least a small profit, but if you take this short, your stop is here, or maybe even here, so you're risking more. And the same is true here. If you buy the first entry above this bar, your stop is right below, your probability is not all that high. If you wait until there's a breakout and follow through, and then buy a close, the probability of making a profit is higher, but your stop is further away, either here, here, or here. And that's always the trade-off. If you wait and take the higher probability entry, you pay for it with worse risk-reward. The stop is further away, so you're risking more, and you're entering late, so there's less reward remaining in the trend. However, the math is good both for the early entry with lower probability, better risk-reward, and the later entry with greater risk, less reward, and higher probability of making profit. A parabolic wedge is a channel. We have a first push up, a deep pullback, a very strong second leg up to this high, and then a third push up there. If you want, you can call it a second leg trap in a possible trading range. First leg, pullback, second leg, which it is, it's both. The second leg had 3 very big bull bars, and the tail on top represents the end of the second leg, and then we pulled back to the low of this bar and started the third leg. We have a pullback bar here, this tail plus the low of that bar, and it's the end of the second leg, and then we have the third leg up. You can take the short below that bull bar or below that bear bar, or wait until you see 3 or 4 consecutive bear bars and then either sell the close of this bar or sell the close of that bar. At that point, the probability of making a profit is greater. If you take this later short, your stop is still up here, and you're expecting at least a small second leg down. This represents the market flipping to always in short. The bulls are giving up. They understand that this is a bull trap and that the market is probably going to trade down. In this particular case, we had a parabolic wedge top, and we have a first leg down, a pullback, a second leg down, and then a bull bar, a pause, and then a third leg down, a parabolic wedge bottom at the bottom of a trading range with a good-looking bull bar. You can see parabolic, if I connected the low of the first push and the second push, I get one line, and then if I connect the low of the second push and the third push, I have an even steeper line, and therefore it's a parabolic curve accelerating downward. It's a failed breakout below the bottom of a buy climax, a bull leg, and it's also a failed breakout below the bottom of a bull trend. In this particular case, it formed a perfect double bottom with an earlier low, the bottom of the trading range, and you have a very strong buy signal bar. Even though the channel is very, very tight and you think the reversal up might be minor, this is a reasonably good probability trade for at least a couple legs up, 1 pullback, 2 or 2. We have a parabolic wedge here, a first push up, and then a tail. You can say we went up, down, end of the first leg. And then we have another pair of consecutive bull bars with a small tail on top, end of the second leg, and then a pullback to that close and that low, and then a third push up. For me, this is a parabolic spike and channel bull trend. It's a parabolic wedge. First push up is the spike, and then a pullback, and then a couple more pushes up. This bull bar, and then a small bull bar, pause, and then a bigger bull bar again. On a smaller time frame chart, you could see that this is a pullback here, and this as well, from that high to this low. But you don't have to look at the chart. You can infer it by simply looking at this chart. We have a pause and then a bull bar. 2 bull bars. A pause and then a bull bar closing near its high. 3 consecutive bear bars closing on their lows. The market probably is in the process of reversing from a parabolic buy climax. Look at bar 3 right here. Bulls are buying for any reason. They're buying closes. They're disappointed by this bear bar, and they decide maybe it's a parabolic wedge top, maybe I should get out break even. They placed limit orders to get out at break even at that close, and look what happened here. It got right to their entry at that close, and their limit orders did not get filled. The market turned down. The bulls started giving up, and then they continued to give up here. These 3 consecutive bear bars represent the bulls giving up. It's a give up series of bars, and the bears are doing the opposite. They know this is a potential parabolic buy climax. They know the bulls are disappointed by this bear bar, and the bears start to short with a limit order just below that close, believing that the bulls will try to get out at that close. When the market gets near that close, the bears start to short with limit orders or at the market, and they turn the market down. After the second or third bear close, bears start selling closes. It becomes a sell the close bear trend, and the bulls are giving up. No one left to buy. We have a series of bear bars, a pause, a series of bear bars, and then a small bull doji, a pause, and then another sell climax here. You have 3 pushes down, 1, 2, 3. Parabolic wedge bottom, which is a sell climax, and it led simply to a trading range instead of a reversal. Very common when you have a sell climax or a buy climax for the market to go sideways instead of reversing. This is a very common pattern. Very strong breakout, second push, third push, or third push. We can call it a nested parabolic wedge, 1, 2, 3, and the third push divides into a wedge, 1, 2, 3. In any case, spike, pullback, parabolic channel, and then you get a pullback, 5 bars or 10 bars. It's still a bull flag at this point. 20 bars, probably still a bull flag. Maybe 25 bars, it still looks like a bull flag. The bulls are trying to buy, they're trying to buy again. But once you get this, a pair of consecutive bear bars closing on their lows, decent sized bodies, the bulls are giving up, the bears are taking control. It's probably going to be a measuring gap for a measured move down. You have a pullback that's endless. It just keeps going on for 10 bars, 20 bars, 30 bars. And that often is the start of a bear trend, especially after a parabolic buy climax. And if you start to see it pulling back in a tight trading range that slopes slightly downward, After 5 or 10 bars, you have to be thinking that this could be an endless pullback that will convert into a bear trend. You can wait. There's no good buy. However, once you see the breakout, it's a good sell. Some bears will sell here, below that bar. Others will say, okay, you get disappointed bulls here. They'll probably try to get out break even if they bought that close. So there'll be some sellers at that close. You can see that tail on the top of this bull bar. And then another bar with a tail on top. It looks like the bulls are giving up. More bulls will sell below that bar, and bears will sell as well, taking a chance that the buy the close bulls are giving up, and they'll wait 5 or 10 bars to buy again. And it never got back to that price again. No consecutive big bear trend bars, but 13 bars in a bear microchannel. No pullbacks for 13 bars. Possible endless pullback. And when you see an endless pullback, there's a 50-50 chance you're going to get a bear breakout and a swing down. The bulls are trying to reverse, 2 legs down, 1, pullback, 2. But where is the follow-through buying? No follow-through buying. That means this might instead be a double top bear flag. A double top with this bull bar, slightly lower low. We have another tight trading range, and then we get the bear breakout. Bear breakout and follow through, it's now always in short. All through here, it's always in long. The probability favors trend resumption up. But with each bar that gets added, it becomes more and more neutral. After about 20 bars, it's almost 50-50. Maybe slightly higher probability for the bulls. But once you get the bear breakout and follow through with a pair of decent sized bear bars compared to the bars to the left, the market becomes always in short, and you're going to get probably a measured move down. From the top here, in the middle of the gap, I could have used the breakout point, which is this low or that low, and we got a measured move down. And what took place at the measured move down? Bears bought. They took partial profits here, very tight bear channel, even though good bull bar. A lot of the bears, if they do get out here, they'll sell again below a bear bar, like maybe below that doji bar for trend resumption down. This did not do enough to reverse it back to always in long. Here we got a gap up on the open, 3 pushes up, first push and then a pullback, second push and a pullback, and a third push. And now we have a bear body. Possibly a parabolic wedge reversal on the open. Is this particularly climactic? Well, not especially. We have 2 decent bull bars here and here. That means if it's not especially climactic, the bulls may not be exhausted, and instead of reversing into a bear trend, it might be simply a reversal and then a trading range, which is what we got. Without the climactic look to it, without extreme buying, consecutive big bull trend bars closing on their highs, this is more likely going to be a bull leg in a trading range rather than a climactic end of a rally and the start of a bear trend. The bears had a chance here, but you can see once the market got to the prior low, traders bought it. Trading range behavior, new low, reversal up. On the other hand, we have a pair of bear bars here, 2 big bear bars here, another big bear bar here. This is much more climactic than this was. Much more chance that this is going to lead to a reversal, especially with a pretty good looking bull bar. Yes, it's a sell vacuum test of the bottom of the trading range. We have a double bottom, a bear breakout, tried to reverse here, failed, tried to reverse again here. Good looking bull bar, and we got a successful reversal. Couple legs up, 1, pullback 2. This was simply a sell vacuum test of the bottom of a trading range, and we got a failed breakout below the range. I call this a double bottom, this low and that low, even though they're not at the same level. The market tried to reverse here. This is so strong, probably at least 1 more leg down. We got 1 more leg down. 2 attempts to reverse here and here, even though not at the same level. It's a type of double bottom. It's also a parabolic wedge. 1, pullback, and then second sell climax, pullback, and then a third final sell climax. Parabolic wedges are common on the open in the first hour or so. Anytime you see a strong rally with a pause and then a series of buy climaxes on the open, you always have to be thinking about the possibility of a parabolic wedge. Here, it's a possible parabolic wedge top. First push up, pause. Second push up, pause. Third push up, and then even a fourth push up. Is the parabolic wedge 1, 2, 3, or 1, 2, 3, 4? It doesn't matter. It's a series of buy climaxes on the open, and you have to be thinking about a possible parabolic wedge. And as often happens after a parabolic wedge, especially on the open, you get a pullback, and it forms a tight bear channel lasting about 10 bars, and then the market decides whether it's going to resume up or reverse down. Here, we get a big bear breakout, probably at least a measuring gap for at least a couple legs down. 1, pullback, 2. "13 bars up without a pullback. That alone, a 13 bar bull micro channel alone, is a type of a climax because it's unsustainable, and anything that's unsustainable is a climax. And then we have consecutive buy climaxes, a pair of bull bars, big bull bar closing on its high, a pair of bull bars, this one closing on its high, and then another attempt. Climactic behavior. You can call it a low 4 if you want. We tried to get a low 1, failed, tried to get a low 2, failed, and then we get a breakout, tried to get a low 1, failed, and then tried to get a low 2. It's a type of low 4. We have consecutive tops. We tried to get a low 2 top here, instead got a breakout, and then tried to get another low 2 top here, and succeeded. Big bear bar, closing below the lows of the past 20 or 30 bars, far below those lows. The market's always in short for at least a small second leg down. The scale-in bulls who were buying all the way down gave up. They were overwhelmed, probably a measuring gap. The bulls tried to reverse here, but look at this high compared to that low. This is simply a breakout test of that low, and it failed, and we got a big second leg down. So leg 1, pull back leg 2. Parabolic wedges need extreme moves as a sign of exhaustion. Without the extreme moves, the traders do not get exhausted, and the trend can go a long way. Here, 3 pushes down, 1, 2, 3. Very tight channel. If you want, you can call it a parabolic wedge. I would not. Where is the extreme selling? You know, we get a bear bar here, but it's small compared to these bars and these bars and this bar. This does not look climactic. It does not look like the bears are worn out. And the result was we have a wedge, but not climactic selling in a very tight bear channel. This is probably going to result in a minor reversal and a bear flag, and then continued lower prices. This is more likely a small pullback bear trend than a climactic wedge bottom. No big bear bars, no extreme selling, no climax. It's not yet overdone, and therefore the trend can go down much further. Again, the pattern is just too small to reverse a big bear trend like this, and the channel is too tight. Probably the best of the bulls yet is a bounce, and then the bears will get trend resumption down. No buying pressure. Where are the big bull bars in any of this? Minor reversal, do not buy. Do not buy a minor reversal in a tight bear channel. This is the dollar versus the yen, a 5-minute chart. We have a strong bull trend and a very abrupt reversal down. Big bear bar, a pair of bear bars, another big bear bar, 3 big pushes down, climactic, consecutive sell climaxes. You could even say sell climax, sell climax, sell climax, sell climax, sell climax. This is a parabolic wedge bottom, double bottom with this low, could be a spike pullback parabolic channel, and a double bottom with the bottom of the channel. You can also call it simply a parabolic wedge bull flag. It's a parabolic wedge bottom, but it's above the bottom of the bull trend. It's around a 50% pullback, and it's testing the bottom of a channel after a spike up, spike, pullback, parabolic channel. And then we reverse down, testing the bottom of that channel. A very good looking bull bar. It's a reasonable buy. You can see that you can draw a best fit channel, and this is within that channel. Strong bear bars, each one with bad follow through. A series of sell climaxes, each one with bad follow through. You have to be thinking that this is unsustainable behavior and probably a bear leg in a trading range or a bear leg and a bull flag, and the market will have at least a small reversal up. Bull bars after every big bear bar. That is not how bear trends look. That is how a bear channel that's about to have a bull breakout looks. Bear channel, bull flag, chances are you're going to get a bull breakout. Again, 50% pullback and a bull trend, probably a parabolic wedge, bull flag. Trends always have wedge reversal patterns, and strong trends always have bad-looking wedges. Lead to minor reversals, not trend reversals. Very strong bear trend, and if you look at it, real time, as the bars are unfolding, you'll constantly see wedge bottoms. But when a channel is this tight, a small pullback bear trend, each one of those wedge bottoms will lead to a minor reversal and a bear flag, and the bear trend will continue. There's just no significant buying pressure. A little bull bar here, a little bull bar there. Remember my 80% rule. 80% of reversal attempts in a strong trend will fail, and the trend will continue. 3 pushes down, 1, 2, 3, wedge bull flag. Very tight bear channel. Where are the bull bars? No buying pressure. This is not a tradable bottom. it's going to lead to a bear flag and a resumption of the bear trend. 3 more pushes. We have another wedge. We have tails. We have a bull bar. Is this a good buy? No, it's a very tight bear channel. Any reversal is probably minor. The best the bulls probably can hope for is a small trading range. More likely, there's going to be trend resumption down. We have a gap here, this low, that high. This might in fact be a measuring gap. In fact, it was. Another wedge bottom. Maybe we should buy. Maybe we should buy this. Very tight bear channel. Minor reversal. Probably bear flag. Another wedge bottom. Certainly this has to reverse at some point. Beginners are constantly seeing wedge bottoms and bear trends. This is a small pullback bear trend. The pullbacks only last a bar or 2 or 3 bars, and they don't go up very far. All of these pullbacks are bear flags. The trend will continue. Do not be too eager to see wedge bottoms in bear trends, especially a small pullback bear trend like this. All of these wedge bottoms will lead to bear flags and the trend will continue. Never look for a reversal when the channel is tight, because a tight channel is a breakout on a higher time frame chart. If this is a 5-minute chart and you look at a 15-minute chart, it'll be simply a series of big bear bars closing on their lows. And you do not want to be buying if every bar is a big bear bar closing on its low. Gaps all the way down, this high, that low. This breakout point, these highs, this low, this high. Gaps all the way down, very strong bear trend. Whenever you see gaps all the way down and the pullbacks lasting only a bar or 2, and not any consecutive big bull trend bars, don't even think about buying. Anytime you see a buy setup, wait for it to fail and reverse down and then look to sell. Expect trend resumption. Expect every reversal to be a bear flag. And constantly look to sell. We're trying to reverse up, sell below a bear bar. Trying to hesitate, maybe base, sell below a bear bar. Sell below the prior bar, sell below the prior bar, sell below the prior bar. Again, 80% rule. If you're in a strong trend, 80% of reversal attempts will fail to reverse the market, and they'll become flags and the trend will continue. Wedge top, 1, 2, 3. But where is the selling pressure? Very strong bull breakout, a 1-bar pullback. A wedge top, but look at the pullback since this low. The pullbacks are just a bar or 2 and just really tiny. Chances are the best the bears get here is a trading range, not a bear trend. A low probability sell. Another wedge top. This time for sure it has to work. We have a bear bar here, the sell triggered. This went below that low. Another sell that triggered. A third sell that triggered. Certainly one of these reversals has to work. The pullbacks are way too small. Where are the big consecutive bear bars? Where is the evidence that the bears are strong? A sell signal bar alone, even if it's a third push up, is not enough reason to short a strong bear trend. Another wedge top and another sell. Look at all these great sell signal bars here, here, here. Now our fourth one. One of these has to work. Well, eventually one will work, but these are all low probability shorts. A bear signal bar alone is not enough reason to sell a wedge. There has to be some evidence of selling pressure, and when the pullbacks are really small like this and the channel is very tight like this, there's no significant selling pressure, so only look to buy. Every time the bear trend reverses, the bulls have to buy again. For example, above a bull bar. Bear trend reversing, buy above a bull bar. Bear trend reversing, buy above that doji or above this bar or even above this bull bar. Third push up, eventually it was successful, but it's still a low probability trade. Higher probability to wait until we get 3 or 4 consecutive bear bars and then sell. The sell signal bars alone are not reason enough to erase the bad context. It's a small pullback bull trend. Do not look to sell. Very tight channel. I don't have the bottom of the channel drawn, but you can see it's a very tight channel. It's a breakout. It's a bull breakout on a higher time frame chart. You only should be looking to buy. Until there's reasonably good selling pressure, bet that each reversal will become a bull flag, not a trend reversal, and buy above a bull bar after every reversal down. Now, I said most wedges in strong trends fail, and that is true. However, most strong trends end with at least some kind of a wedge. Wedge bottom, these are all meaningless. The bear channel is too tight to be looking for reversals. It's far too early to be trading this. It's a small pullback bear trend. It's a very tight channel. It's a bear breakout on higher time frames. Stop looking for reversals. Instead, look to sell a failed reversal, a bear flag. Whenever you see a bear trend that lacks consecutive big bear trend bars, This lacks consecutive big bear trend bars. Yet, it's forming gaps. Instead of looking at it as a possible bear leg in a trading range, you have to be thinking that it could be a small pullback bear trend, and it could last a long time. Do not look to buy reversals. Now we're starting to get stairs. We have a big bear breakout, and we broke below this low, but it pulled back above that low. The gaps are closing. We're starting to accumulate some bull bars. Here, 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 again here, and again here. There's some evidence of buying pressure. We have a wedge bottom, 1, 2, 3. I would consider buying this, betting that it's a spike in channel, bear trend, so spike, second push, third push, and then it will evolve into a trading range. However, it's higher probability to wait to buy a major trend reversal. Strong bull breakout, and the bulls are so strong they were able to create gap bars. 2 bars where the lows are completely above the moving average. There's a gap between the low of these bars and the moving average. That usually leads to the final leg of the bear trend before there's a major trend reversal attempt. Higher probability either to buy here for a scalp. This is probably a minor reversal because it's a tight channel. First reversal up probably will lead to trend resumption down. However, it's a strong enough breakout here, gap bars here. That strong trend resumption down will probably fail around the old low, and the bulls will try to get a major trend reversal. I would not buy above this bar after that big bear bar, but now we have a second entry buy. This is a higher probability buy. Higher low, major trend reversal, micro double bottom, this low and that low. It's a second entry buy, above here, above here. Higher probability to buy after you see a reasonably good breakout, and especially after you see 2 big bull bars closing on their highs. Probably going to get at least a small second leg up here or here. Bull breakout with follow through, a pair of consecutive bull bars. Resistance is always a magnet, just as support is a magnet. If you're reversing up, resistance is therefore a target. Whenever the market gets to some kind of a resistance level, there'll be some profit taking, which means there's often a pullback. If we're talking about resistance in a bull trend, bulls will take partial profits. The bears know that the bulls will take partial profits, and the bears will sell, at least for a scalp. Where's resistance? Well, first of all, the most recent lower high in the bear trend is resistance. And when the market got there, the bears tried to get a double top. The bulls took partial profits, 2 legs up, 1 pullback 2. Minimum goal for a wedge bottom is 10 bars, 2 legs up. We have first leg up, pullback, second leg up. A reasonable area to take profits around that prior high, in case we get a double top, a break below the neckline, and fall for a measured move. We have a sell climax here, and tried to get a double top here. Instead, we broke to the upside, possibly a measured move up based upon the height of this double top attempt, and you can see additional profit taking there. You could also draw a measured move up from this low to that high, a measured move up from the bottom of the trading range to the top of the trading range. All of those are possible resistance areas. We have another lower high in the bear trend. It's a major lower high. It led to a new low and a strong bear breakout. So there'll be some profit takers around there as well. A wedge bottom, it's a bear channel. And a bear channel is a bull flag. 75% chance you'll get a bull breakout. Only a 25% chance you'll get a bear breakout and then a swing down for a measured move. A bull breakout does not mean bull trend. It simply means a break above the top of the channel. It could result in a trading range, as it did. But once it enters a trading range, then traders will look for a major trend reversal, which we got. A wedge top, it's a bull channel. A bull channel, a bear flag. 75% chance you'll get a bear breakout, at least into a trading range, possibly into a bear trend. This wedge top is at the prior high, so it could be a consecutive series of buy climaxes testing the top of what could become a trading range. Bull channel, bear flag. Only 25% chance of a bull breakout and a swing up. 75% chance the market will break below the bottom of the channel, which simply means breaking below the bull trend line, which it did. And it could simply go sideways and then resume up, but 75% chance you'll break below the bottom of the channel. Bears, we have a double top, we have a wedge top, a lot of trading range price action here, and then we're starting to get consecutive buy climaxes. A second entry short, first is below that bull bar. Now we have a big bear bar and a pause bar. That is a short below that bar. Here we have a double top bear flag, this high, that high, and we have a bear bar closing near its low. It's an okay short, betting that we get a swing down, which we did. Wedge bottom, 75% chance there'll be at least a small bull breakout, Here we got a very strong bull breakout. Wedge bottom, a lot of buying pressure in here, and we have a failed bear breakout, reversed up. And now we have a bull bar here, a bull bar here. This is the third attempt to reverse up. You can also say it's the third failed bear breakout attempt. We tried to break to the downside here. We tried again here. We tried again here. The bears are repeatedly trying to go down. The bulls are repeatedly trying to go up. The bears probably eventually give up, which they did. Here's a give up bar. The bears are giving up. Now we have a wedge bottom. 1, 2, 3. 75% chance you'll get a bull breakout. Maybe a conversion into a trading range. We have a spike pullback channel, and we have a pullback testing the bottom of the channel. 75% chance we'll go sideways. 25% chance you get a bear breakout below the bottom of the wedge and a two-legged swing down. This is that 25% chance. An attempt at a wedge bottom near support, the first pullback after a strong bull breakout. Instead of reversing up above the bull channel, which it does 75% of the time, we have a successful bear breakout, which we get 25% of the time. Bears could sell the close of that big bear breakout bar, or they could wait for the double top bear flag. The market went up and then down and went up again, so now we have a double top, this high and that high, and we have a good sell signal bar here, a reasonable short there. We have another bear breakout and a pullback. This is a low one short below that bear bar. We have a wedge, bull flag, and got a bear breakout. You have to be thinking that it might fall for a measured move down, which it did. So this is a reasonable location to take at least partial profits. And you can see some buying here. It's also around the prior low, another reason to take partial profits. This is the S&P Cash Index, a monthly chart. Here's the 1987 crash. We got 3 pushes up, 1 pullback, 2 pullback, 3, and it's subdivided into a nested wedge. But a very tight bull channel. We got the bear breakout, but what followed? We failed a bull breakout here. We got a reversal down here. But the bear breakout failed here. The bears tried again here, they failed. They tried again here, they failed. We're getting a failed bear breakout below a very tight wedge bull channel. At some point, after maybe 3 or 4 bars, you have to decide the bulls have won and that we're going to get some kind of a measured move up, which we did. We have a 13-bar bull microchannel on a monthly chart. That is incredibly strong. It led to a bull trend that lasted 6 years and gained 300 points. A bull breakout above a wedge top. 25% chance you get a successful bull breakout above a wedge top. And this was one of the most successful bull breakouts above a wedge top in the past 50 years. I began by talking about parabolic wedges and how they can lead to reversals. I also talked about how strong trends are constantly forming wedge reversals, but if the channel is tight, those reversal attempts will be minor and become flags, and the trend will continue. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 4th of 5 videos on wedges. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th of 5 videos on wedges. In this video, I'm going to be talking about wedges that break in the wrong direction, a failed wedge. We have a bull trend here, and then a pullback, and it might be a wedge. 1, 2, 3, wedge bull flag, and it tried to break to the upside, and it tried to break to the upside again a second time. A wedge bear channel, and therefore a bull flag, and it's more likely to get a bull breakout. Instead, look what we got. We got a bear breakout here, and an even stronger bear breakout here. So here we're getting a bear breakout below a bull flag. Whenever the market does something that seems unlikely, you should always expect an accelerated trend, a fast breakout, and if the breakout is strong, the odds are you'll get 2 legs down. 1 pullback, 2. And whenever you're in the process of getting any kind of a breakout, you have to be thinking about a possible measured move. The top of the wedge is here, the bottom of the wedge is here. The bulls thought they were going to get a rally up to the top of the wedge. Instead, the bears got a breakout, so you have to be thinking that the bears will get the same distance that the bulls were hoping to get up here. A measured move based upon the height of the wedge. When the market falls for 2 legs and around a measured move down, the bears will begin to take profits, and the bulls will look to buy as well, thinking that the bears will take profits and you'll get at least a minor reversal. Here, the bulls tried to reverse up above a doji bar. It failed. The bears tried to resume down again, but then we got a bull inside bar, and the bulls bought above that bar, and the bears gave up above that bar. You'd expect at least a couple legs sideways to up. We got a first leg up, and then a triangle, and then a second leg up. We have a fairly strong bear trend, very strong breakout, and then a weak looking rally. You can call it a bull channel, you can call it a wedge. There are 3 pushes up, 1, 2, 3. Does not matter that the first push up began before the bear trend ended. That's very common for a reversal or a trading range to begin before a prior trend ends. Anyway, 3 pushes up, 1, 2, and 3. Bull channel, bear flag. Odds are there'll be a bear breakout. However, sometimes you get a bull breakout above a bear flag. And when the breakout's strong, you're expecting at least a couple legs up, 1, pullback 2, and probably a measured move up. The bears are giving up. They're hoping for any kind of a pullback so that they can exit with a smaller loss. And the bulls who did not buy initially are hoping for any kind of pullback as well because they are eager to buy, and the result is a second leg up. Again, the bears wanted a bear flag and a bear breakout and at least a test of this low. And the bulls are expecting the same distance, but up once they got their breakout. And you can see the profit taking around the area of a measured move up. Aggressive bears will sell up there, taking a chance that enough bulls will take profits to get at least a more minor reversal down, a profitable scalp. Here's a small wedge, 3 pushes up, 1, 2, and 3. A wedge bull channel, a wedge rally. You have to be thinking bear flag, and we get a bull breakout. You have to expect 2 legs up, 1, pullback, 2. Bear trend, a weak rally, 3 pushes up, 1, 2, 3, so a wedge bear flag. Instead of a bear breakout, we have a bull breakout. The height of the wedge, here's the beginning of the wedge, the top of the wedge is here or here. You can simply call it a trading range, a bull breakout above a trading range. In either case, whether you look at it as a wedge or a trading range, you have to be thinking that traders will take profits at around a measured move up. Also, a dramatic sell climax late in a bear trend, probably an exhaustive move, and the market usually tries to get to the top of that sell climax bar. And then bulls take profits on their scalps, and bears look to sell again. The market sold off quickly when it was at that price before. Maybe it will sell again at that same price. It's a small pattern, so it's probably a minor reversal. A minor reversal means usually a trading range or a larger bear flag, in which case we did get a larger bear flag, and we also got a trading range. Bulls buying this probably will scalp because this is not a credible major trend reversal. We did not have enough buying pressure. After this, that's a lot of buying. Then bulls might buy for a swing up, higher or low, major trend reversal. This, I think, is a special type of pattern, and it's important. We have 3 pushes down, 1, 2, 3, so you can call it a wedge bull flag. However, it's mostly horizontal. This breakout is a small breakout of here. This is a small breakout of that. So it's a small breakout of a small breakout. It's a wedge, 3 pushes down, 1, 2, 3, a wedge bull flag, bull trend, wedge bull flag. When you get 3 pushes down like that, 2 lower lows, and the pattern is mostly horizontal, and the bull trend tries to resume, yet it fails to break above the top, there's an increased chance that the breakout below the bottom will fall for a measured move down. In general, if you get a breakout below a small breakout of a small breakout, in other words, basically a horizontal wedge, 60% chance you'll get a measured move down, usually 2 legs down, maybe 1, pullback 2, or other computers will say 1, pullback 2. Other computers will say 1, pullback 2. Trading range, a lot of bear bars, so good selling pressure. Lower highs, lower lows, it's a wedge, but it's mostly horizontal and the breakouts were small. Special type of pattern, if you get a bull reversal and it fails to break to the upside, be ready for a breakout below the bottom of the wedge and a measured move down. Higher probability of a measured move down from this type of wedge than from a break below other types of wedges. Small breakout here, and then a second small breakout. Small breakout of a small breakout, 3 pushes down, so it's a type of wedge bull flag. And when you start to get a strong breakout, the odds are 60% that you'll get a measured move down. A bear breakout below a wedge bull flag. Again, first leg, maybe second leg. Other computers will say this is the second leg. measured move down based upon the height of the wedge. It's also a trading range. It fell for more than that. You can see some profit taking around a measured move down, and then it fell below it and more buying. The market's in a bull trend. 3 pushes up, 1, 2, 3. Bears will sell here, and now we have a double top, lower high. They'll sell below that bear bar here. However, if the market breaks above the top of the wedge, bears will exit. In general, 75% chance you'll get a bear breakout below a bull channel or below a wedge top. And here we did, and we got 2 legs sideways to down. 1, pullback 2. Here, the legs were sideways. Yet, we got a bull breakout above the top of the wedge. Whenever you have an obvious location for a stop, like above the top of a wedge, and the market breaks above it, hits the stop, 50-50 chance you're going to get a measured move up, 50-50 chance the breakout will fail, and the second top will lead to a reversal down. A wedge top, we tried to reverse, it failed. We're breaking to a new high, and now we're trying to reverse again a second time. Bears will either sell below this bar, or now we have a micro double top, they'll sell here, and now we have a rally to a lower high with a pair of bear bars closing near their lows, they'll sell here or here, looking for a measured move down. Strong enough breakout, second leg down, likely, rally to a lower high, major trend reversal. The breakout above the wedge is a surprise. Very often, you'll get a second leg up, especially when the breakout has a pair of strong bull bars like this. Usually, you're going to get at least a small second leg up. And a lot of bears will wait until after the micro double top, and then they'll look to sell the reversal down. Whenever there's an obvious location for a stop, a wedge top up here, 50% chance the breakout will lead to a measured move up, 50% chance the market will try to top again and be successful. You could also view this as a larger wedge, 1, 2, and 3. Some bears know that the probability is 50% if the market gets above this high. It's 50% chance of a rally, and therefore they're willing to take the chance. They do not exit. They'll use a wider stop, and a lot of them will sell more at this high, betting that the bull breakout will fail. They know 50% chance the bull breakout will fail. Wedge bottom, 3 pushes down, 1, 2, 3. Fairly tight channel, so probably minor reversal, but pretty good buying pressure. You might get a couple legs sideways to up. An obvious location for a stop is below the bottom of this strong buy signal bar. In general, if the market hits a stop, a reasonable stop, an obvious stop, 50% chance the break below the buy signal bar will lead to a measured move down. 50% chance the breakout will fail, and you'll get a second reversal. Here we have a wedge bear channel, 75% chance bull breakout, probably a couple legs sideways to up. In fact, here we did get 2 legs sideways, 1 pullback 2, but the pullback fell below the bottom of the wedge, and a lot of bulls will have their stops there, and they'll get out. Other bulls will say, 50-50 chance it'll reverse back up again, which it did. So we have a wedge bottom, a bear breakout, 50-50 chance you'll get a swing down, 50-50 chance you'll get a reversal up. The bear trend resumed after just 1 leg up. You can argue double top bear flag, a bear inside bar. Some bears will take that short, some bulls will get out there. But the bulls who relied on their stops, most will get out at that low, and they'll look to buy a reversal up. Micro double bottom, a bull bar, a lot will buy above that bull bar and get filled here. Bear breakout below the wedge, a lot of bulls will get out. Most bears will not sell. The sell-off does not have much momentum. They'll wait to see if there's a big breakout bar. Not a lot of bears selling down here. It's reasonable to get out of longs and then buy the reversal up. It's also reasonable to look at this and say it's not a particularly strong sell-off. We're probably already in a trading range, and therefore the break below that low will fail. In general, 50-50 chance the bear breakout will fail. I adjust that percentage depending on what's going on, and with this sell-off not being particularly strong, bear bar doji, bear bar small bear bar bull bar, I think there's higher than a 50-50 chance the bear breakout will reverse up. The breakout below the bottom is a surprise, and a possible second attempt to bottom. We tried to bottom here, it failed. We fell below that low, and now we got a micro double bottom, and the market's trying to bottom again. It's very common to have a wedge that tries to reverse, and we either get a double bottom or a slightly new low, and the market then tries to reverse a second time. So it's consecutive bottoms. A bottom attempt, a bear breakout, and then a second bottom attempt. and here we now have a higher low major trend reversal. Bulls will buy reversals up. They'll buy here, failed breakout below the wedge, and a micro double bottom. They'll buy above that bull bar and get filled here, or the higher low major trend reversal, or a breakout here. We're trying to break out. We got a small bull flag, 2 legs down, 1 and then 2. Bulls will buy above that bar or above this bar, and they got a good breakout. Some bulls will look at this sell-off and look at this bottom attempt and say, pretty good bottom attempt, pretty good buying pressure. Not all that strong, bad follow through, a lack of consecutive bear bars, probably more buyers than sellers below this low, and that's true. Some of these bulls will not exit here. They'll use a wide stop, maybe based upon a measured move down, so stop somewhere down here, and they'll buy more, either at this low or on the reversal up. Stop just below a measured move down, either from the height of the wedge or from the height of this initial rally. I talked about failed wedges and how if you have an obvious stop and the wedge stop gets hit, 50% chance the breakout will lead to a measured move, 50% chance the breakout will fail, and you'll get a second attempt to reverse. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the 5th and final video on wedges. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 2 videos on double tops and bottoms. I use a very broad definition of a double top and a double bottom. I'll then move on to talk about why double tops and double bottoms work. And next, I'll talk about double top bull flags and double bottom bear flags. I'm moving through the list of reversal patterns. A double top or a double bottom can be either a flag, a continuation pattern, or a reversal. They're present on every chart, and many of them are present on every chart, and there are often 2 or 3 ways to draw the lines. Again, they can be a pullback in a trend, or they can be a reversal leading to an opposite trend. Many of them are too small to trade profitably on the chart in front of you. However, if you were to trade down to a smaller time frame chart, they would be big enough to trade. Many are good for swings, many are only good for scalp trades. I think it's very important to be flexible in how you define a double top and a double bottom. You have to be that way because the computers are, and they control the market. The concept is if there's a rally and then a pullback and then another rally, it's testing the high of the first rally. Will the rally continue or will it reverse? And the opposite is true at a bottom. If there's a sell-off and then a pullback and then the bear trend resumes, will the bear trend continue past the prior low or will it reverse? It's testing the prior low. For example, we reversed down here, we tried to get up there again, and we reversed down again, but at a lower price. This is a double top. This tested that high and could not even get close to it. We pulled back and we went up again, and this time we went to a new high. We twice tried to go above it here, pull back here, and then even a third time, and we failed. This high then became a double top test of this high, and it led to a reversal. It's a slight higher high double top. Strong bear breakout, a reversal attempt, the bear trend resuming, yet it reversed up again from around the same price. There are more buyers than sellers at this price. This is a double bottom. It's a higher low double bottom, but it's a double bottom. Bull trend, pullback, break to a new high. This is testing that high. It's also testing this high. So it's a double top with this for some computers, a double top with that for other computers. It's also a micro double top with this. It went up, it reversed. It went up again, reversed again. This is testing that low and that low. So it's a double bottom with this low. Other computers would say it's a double bottom with that low. Micro double top, we went up and down and then up again. You might not be able to see the small blue line on top of that red line. Micro double bottom, we went down, reversed up, sold off to that same price again, and again found buyers and reversed up again. Micro double bottom, bull flag, 2 pushes down, 1 pull back 2. Big sell-off. We went back up to that price again over here and reversed down again. This is a double top with this. And within it, there's a micro double top. On this bar, the market went up and down. Next bar went up, and the third bar went down. Micro double top increases the chances of a reversal. Here's a small double top here. Here's a micro double top here. up and down, up and then down. Micro double bottom. The market went down, and then on this bar, it went up and down again, and went a little bit lower on this bar. So it went down, up, and down, and then reversed up. It became a bear flag, but it's still a micro double bottom after the breakout below these lows. Micro double top. The market went up and down, and then went up on this bar and a little bit more on that bar, and reversed down. Bear flag, testing this breakout point. Top of the bear flag, we sold off strongly. We're back up at that price again. Will we sell off again? Probably not after 8 bull bars. However, it was an attempt by the bears to get a double top. It became a bull flag, small bull flag. This next attempt to reverse down around that high succeeded. So this is a double top. The market sold off down to this area. It collapsed, yet found buyers. Tried to sell off again, found buyers. Went up and down here, tried to sell off again, and found buyers. This is a double bottom, a higher low double bottom. Micro double bottom. The market went up for 3 bars, tried to resume down in a bear flag. Instead, the bulls bought it and went up again. And then down again, twice trying to resume the bear trend, and the bulls bought it again. A micro double bottom led to a breakout. This high, these lows, measured move up to here. Double bottom bull flag. The market rallied here. The bears wanted a double top. It sold off briefly to form a tail on the bottom of that bar. It tried to form a micro double top here and sell off again from a bigger double top here. The bulls bought it again. A small double bottom bull flag. A bull breakout above that high, and the bears tried to reverse, and the bulls bought it again around this price. Another double bottom bull flag. The market went up and reversed down strongly here. It tried to resume up. It did pretty well, but at the same price, slightly above maybe, it reversed down again. A micro double top and a double top with that high, and this is a double top with this high. Different computers view the test differently. Micro double bottom and a higher low major trend reversal. Bear trend, bull breakout, 2 legs down. We got a higher low reversal, and it came with a micro double bottom here and another one here. We had a double top bear flag here. The market went up, tried to resume down, went up again, tried to resume down. This low went below that low, so it triggered the low too short. Yet, there were buyers below that bear flag, and the market reversed up. A double bottom higher low, or you could simply call it a higher low major trend reversal. Another micro double bottom, we went down, we went up. On this bar, we also went down again, a little bit more down on the next bar, and we reversed up a second time. The market 3 times tried to go down, here, here, and then from this high to this low. All 3 times failed. When the market repeatedly tries to do something and fails, it often then tries to do the opposite. Here we tried to go to a new low, here, and here. Twice failed, did the opposite. The market went up and down on this bar, and went up on the next bar, and then down on the third bar, micro double top. Up, and then down. It's also a big double top with here. The bulls tried to resume the trend again, 2 legs up, 1 pullback 2, and it's stalling. This high is testing that high, so it's a double top. Will the bull trend break out and continue up, or will it reverse down? We don't know. Double top bear flag. We sold off of 4 consecutive bear bars after a big double top. This could be the start of a big bear trend. Instead, the double top bear flag triggered. It went below the low of the signal bar, but immediately reversed up, and it became a failed double top bear flag. Instead, it became a double bottom bull flag. Bull trend, a reversal attempt, tried to reverse up, tried to reverse down again, and we got a double bottom at the prior low. The bears failed to get their double top bear flag, and we got a double bottom bull flag. It's a small trading range. Trading ranges always have both a double top and a double bottom. When a pullback is small, I use the term flag because it signifies trend resumption is more likely than trend reversal. I talk about this more on the video on pullbacks and bar counting. A bear flag is a small bull trend or a trading range, and like any bull trend, it can end with a double top. Bear trend, and we have a pullback into a small bull trend, it ended with a double top. Bear trend, a pullback into a bigger bull trend, but it also ended with a double top here. It tried to end here, but failed. And then there was a smaller double top here. Bear trends often have double top bear flags. Bull trends often have double bottom bull flags. Bull trend, double bottom bull flag. Never lose sight of the goal. Flags are never perfect, or rarely perfect. What you're doing is looking to enter at the end of the pullback, planning for a resumption of the trend. A bull flag, it's a small bear trend, and like any bear trend, it can end with a double bottom. Many examples. We have an early bull trend, and we have a micro double bottom here. It became a bull flag. The bull trend continued, tried to reverse down, tried to reverse down. Another small double bottom, bull trend resumed. And then another reversal attempt. A 1-bar bear trend, 2-bar bear trend. We get a double bottom, bull flag. This was an attempt at a double top bear flag. Instead, we got a micro double bottom and another micro double bottom. In a double top bear flag, the bulls are trying to reverse the market, and they become disappointed and sell out of their longs, and the bear trend resumes. And the bears are confident that the bull trend reversal will fail, and they sell as well. A second top and a double top bear flag is often a lot higher or lower than the first. It's a low to sell setup. Here we have a very small double top bear flag, bear trend. Here we have a bigger bear trend, and an attempt at a double top bear flag, and then another attempt at a double top bear flag, and this one succeeded. This bull channel is so strong, a lot of bears waited for a second entry to sell. So they'll sell either below that bull bar, the neckline of this small double top, they'll sell here, or they'll sell below that bear bar with the stop. In a bull trend, there's often a double bottom bull flag, and it's 2 attempts by the bears to reverse the bull trend. They become disappointed and buy back their shorts. The bulls are confident that the bears will fail, and they buy as well. The bears twice tried to reverse, and they gave up. They twice tried to reverse, they gave up. They twice tried to reverse here, and they gave up. Here, they tried to reverse here, and gave up. They tried to sell off here, and gave up. And this sell-off, as strong as it was, it's a bear trend, it's a pullback from this rally, so it's also a bull flag. Remember, a bull flag is a bear trend, a small bear trend. Every major trend reversal top is a type of a double top. It's an attempt by the bulls to make the bull trend resume, yet the bull trend fails around the prior high and reverses a second time. Let's say there was a bull trend to the left here, and it rallied, and it tried to reverse. It rallied again to a slightly higher high, and reversed again, higher high major trend reversal. Every major trend reversal bottom is a type of double bottom. The first reversal is a bear flag. The bear trend tries to resume, and it reverses up a second time, and the second reversal up is a major trend reversal. Bear trend, the first reversal up, probably minor, and it will lead to a resumption of the bear trend. If it reverses up a second time, then traders will be thinking that the bears are failing twice, maybe the market's going to reverse. Higher low major trend reversal. Major trend reversals, they're minor double tops and double bottoms on higher time frame charts. Likewise, minor reversals can be major on smaller time frame charts. But on the chart in front of me, this is a major trend reversal, and it's a reasonable swing trade. You can see more about this in the videos on major trend reversals. I talked a little bit about why double tops and bottoms work. I'm going to talk more about that here. A double top, why does it often lead to a reversal down? Let's say there was a rally here. Some bull bought this high. Every price on every chart, there was a bull and a bear. Somebody bought and somebody else sold, taking the opposite side of the trade. This bull bought here, thinking the market was going to go higher. Or he thought that if it reversed down, the reversal would be minor, and then the bull trend would resume and he'd be able to get out around his original price. He was not expecting a bear trend. Again, assume there's a big bull trend to the left that we do not see. He's buying, confident that the first reversal will be minor, and the worst that he'll get is a trading range. And when the market gets up to the top of the range, he'll be able to exit with a profit. If he bought here, he was confident that the worst the bears would be able to do is create a trading range. So if he buys here, he was confident that he'll be able to get out break even, because this would probably be near the top of the range. He's confident the first reversal would be either a bear leg in a trading range or a bull flag. So he buys here, gets out break even here. Some bulls will buy more above this bar, and they'll make a profit on that second entry. Once the bulls see a reasonably strong sell-off, they start wondering if the bull trend has ended and has evolved into a trading range or even a bear trend. And because of that, they'll often look to sell out of their longs around the prior high. If they sell enough, and if bears are confident that they can reverse the market, they'll sell strongly as well, and they can get a reversal 40% of the time. Some bulls are confident that at best the bears get a trading range and not a bear trend, so they'll buy a reversal up, expecting a trading range to come back up here, and possibly the bull trend will resume. However, they'll be sufficiently disappointed by this sell-off that they'll either try to get out of all their position here or at least part of their position here. So bulls will sell around the prior high. Once it gets up there and reverses, traders are starting to think that this could be a major trend reversal down. If enough bulls sell and enough bears sell, instead of a trading range, the market could form a major trend reversal. Again, it's reversing around the prior high. This is a slightly higher high, but it's a double top major trend reversal, slightly higher high major trend reversal. We have a bear trend, and bears are selling all the way down, and it has to be a bull taking the opposite side of the trade. Bulls are buying as well, but some bear sold at the very bottom of this bear trend, expecting lower prices. His belief was, it's a strong enough bear trend, the first reversal up will be minor, which means a trading range or a bear flag. He expects the first reversal up to fail and come back down to around his original entry price, and he'll be able to get out with either a small loss or possibly even a profit. When the bears see 8 or 9 consecutive bull bars like this, they're beginning to think that the bull trend has probably ended and the market has now evolved into a trading range. Big down, big up, big confusion, probably a trading range. Once it's in a trading range, it then could either resume down or reverse up. Because the bears believe the first reversal up will be a bear flag or a bull leg in a trading range, they'll sell below a bear bar, like below that bear bar, below this bear bar, below that bear bar. I personally do not take the first reversal down after 8 consecutive bull bars, but I would start thinking about selling below a small double top here or a bigger double top here, expecting that either the bear trend would resume, or after a bull leg in a trading range, we would get a bear leg in a trading range. In either case, I expect the market to come down and test around this low. The bears who did sell here, let's say a bear sold here and he sold more anywhere up here, he's hoping the market comes down to his prior low so he could get out break even on this short and with a profit on these shorts. He sees a strong breakout and he's hopeful, but it reverses up, and it's reversing up a third time. A lot of the bears will give up, and that's what took place here. The bears giving up, and the bulls buying. The bears who sold here and sold more here, they got a small profit here, and they have a small loss here. The bears are now wondering, with all of these failed sell-off attempts, is this now not just a trading range, but a higher low major trend reversal? And the bears are giving up right here. Bears and bulls buying, it creates a reversal. It could simply be a trading range. Here, it was a swing up, so this ended up as a successful higher low major trend reversal. It's a type of double bottom. The market sold off, found buyers at this price. It sold off again, found buyers around that price a second time, and the bears gave up. Anytime there's a trend reversal and it does not look particularly strong, not enough bars, it's probably a minor reversal and not a major reversal. However, minor reversals can often lead to big moves, at least big enough for a scalp, and often big enough for a swing trade. Sometimes a minor reversal becomes a major reversal. When there's a minor reversal, like here, or even here, it's usually followed by an attempt at trend resumption. And a minor reversal, therefore, is usually a leg in a trading range or in a flag. Minor reversal, trading range. A minor reversal up, it became a bull flag that failed. A minor reversal down, resumed up, reversed down again. This is a minor reversal in this bear trend. It became a bear flag. A minor reversal, bull flag. Probably a minor reversal when the channel is this tight, it became a bull flag. A minor reversal up, it became a bear flag, but it did not fall very far. Up and down, minor reversal. This is even a minor reversal. A big bull trend, maybe a 50% pullback, not quite. First reversal down in a tight bull channel, probably a minor reversal and a bull flag, or a trading range. It's both. It's a trading range. We don't yet know if the bull trend will resume up or if the bears will get a lower high major trend reversal and a reversal down. Whenever I see a minor reversal, I assume a flag or a trading range. The odds of a major trend reversal are small. I use the term micro double top or micro double bottom for a double top or a double bottom that has only 2, 3, 4, 5 bars on it. On a smaller time frame chart, you could have 10 or 20 bars and be a regular double top or a double bottom. But on this chart, if I see a double top or a double bottom that is 5 bars or less, 4 bars or less, I call it a micro double top or a small double top. Micro double top, small probability of a big reversal, but it's usually important confirmation if it's also part of a bigger double top. It increases the probability. For example, we have a 3-bar or 4-bar double top here. I call it a micro double top, micro double bottom here. But this micro double bottom is testing this low. This micro double bottom is the end of a second leg and a bigger double bottom. This micro double top is the end of a second leg and a bigger double top. Same here, a micro double top here and here, micro double top here and here, but part of a bigger double top. It's the second leg of a bigger double top. It increases the probability that the double top reversal will be successful. Here, a micro double bottom and then another micro double bottom. It increases the probability that this double bottom will lead to a swing trade up. I've been talking mostly about reversals, and now I want to talk about continuation patterns, pullbacks, flags. We have a bull trend, not particularly strong, but a bull trend. The bears tried to reverse. The bull trend resumed. The bears tried to reverse again. Traders will expect that the pattern is not big enough for a major trend reversal, and therefore it's probably a minor reversal, and therefore either a trading range or a bull flag. When it gets near this prior low, they expect the bulls to come back again. The bulls bought at this price. Maybe they'll buy at this price again. They'll look to buy a reversal up. A minor reversal down led to a double bottom bull flag. A smaller one here. The bears tried to reverse. They tried to reverse again. Minor reversals. It led to a double bottom bull flag. I'm calling this a double bottom. The second low is slightly below that low, but it's still a double bottom. It's a double bottom bull flag, a double bottom and a bull trend. Not a big enough pattern for a major reversal, and therefore it's a pullback, and I call it a double bottom bull flag. The bulls buying, if they buy above this bar, they might put their stop here, or they might put their stop here. In either case, if they're stopped out, unless there's a major reversal down, they'll look to buy again on another reversal up. An early bear trend, bulls tried to reverse, they tried to reverse here, they tried to reverse here. We got close to that high. To me, it's a double top. This is a small double top here. Some bears would sell below here and put a stop a little bit above here, maybe above the sell climax. We're going up again. Again, the bulls are trying to reverse, but the pattern is too small. We only had 5 small bull bars here. This is probably not a higher low major trend reversal. Bear trend, not enough of a bull breakout for this to be a major reversal. So it's probably a minor reversal leading to either a trading range or a bear flag. Traders will look to sell a reversal down. So they'll sell below the low of that bar, below the low of this bar, below the low of that bar. They'll sell somewhere around here. Some traders will sell with limit orders just below that high, betting that we'll get a double top and the bear trend will resume. Computers don't care if the double tops and double bottoms are identical. Usually they're not identical. If the second low is a little bit lower, you can call it a double bottom bull flag. You can call it an ABC bull flag, ABC. You can call it a high 2 bull flag. Tried to reverse back up once with a high 1, and now a second time a high 2. You can call it a failed bear breakout. We have a bull trend, failed bear breakout. A lot of times it's a triangle, 3 pushes down, 1 at the bottom of this bull bar, 2, 3. Doesn't matter what you call it, you have to understand the process. Not enough bars for a major trend reversal, probably going to be a minor reversal or a trading range. Traders expect the reversal to fail, and they'll look to buy a reversal up, especially a second reversal up. The same with here. Minor reversal, the bears again tried, and the bears will give up above a bull bar. And that's one of the reasons why high 2 bull flags work so well. The bears hold after the first reversal down, but if it reverses up twice, if the bull trend resumes twice, if the bears twice fail to reverse, they give up, especially above a bull bar. And that's why a high 2 bull flag and a bull trend is a high probability buy. The bears give up. Does not matter if the two tops and a bear flag are identical. You just have to understand what the process is. Here, it's slightly lower. You can call it a double top bear flag. You can call it a lower high double top bear flag. You can call it an ABC pullback, A, B, C. Sometimes it's a triangle, doesn't matter. The pattern is too small for a major reversal. This is too small for a major trend reversal up. It's probably going to be a bear flag leading to trend resumption down. Triple bottoms, you don't hear the term used all that often. Some traders want triple bottoms or triple tops to be perfect, exactly at the same price 3 times. Very rare. However, you often get what I call a triple top like this or a triple bottom like this, 1, 2, 3, where it's not quite perfect, but it's still 3 attempts in one direction. You're trying to reverse up, trying to reverse up, trying to reverse up a third time, even a fourth time. If you want, you can call this a triple bottom. You can simply call it a trading range. You can call it a double bottom, high or low major trend reversal. Sometimes when you get a tight trading range late in a trend, here a bear trend, and you get a double bottom, even though it's only a tight trading range, it can be enough to lead to a major reversal. That double bottom forms a triple bottom with the bottom of the bear trend. The market tried to go down, reverse up, tried to go down, reverse up, tried to go down, reverse up 3 times. Tried to go down a 4th time, reversed up. If the market keeps trying to do something and fails, it usually tries to do the opposite. Again, different computers have different algorithms. They'll apply different names to the pattern. Here we have 4 attempts by the bears to resume the bear trend. It's clear the market is struggling to go lower. It's probably gone too far down, so it's going to start probing in the opposite direction. Some traders will look at this as a wedge bottom, 3 pushes down, 1, pullback, 2, pullback, 3. And then we had a micro double bottom, and then we had a double bottom, high or low major trend reversal. And then we had a breakout, and then a pullback from this double bottom, high or low major trend reversal. In this particular case, that's how I would read this. I would see it as a wedge bottom, weak reversal up, a tight trading range with a double bottom in it. I would call that a double bottom, high or low major trend reversal. This is the breakout from it, and this is the pullback. If you want, you can also call it a small expanding triangle. Up, down, more down, up, and then down again. A trading range with 3 pushes up. It doesn't matter if the 3 pushes are up or down. Whenever I see a trading range and I see 3 pushes, I call it a triangle. If you want, you could call this the first push down. So it could be 1, 2, 3. I would personally look at it this way. 3 pushes up. The market's trying to go up repeatedly and failing. Maybe it'll probe in the other direction. Another way to do it, reverse down, reverse down, reverse down. A triangle here. We have another reversal down. You can redraw it and call it a triangle here. 1, 2, 3, or 1, 2, 3. We have 3 pushes down, 3 reversals up. 1, 2, 3. You call it a triangle there. We're trying to reverse up here. 4th reversal up. Doesn't matter how you describe it. You have to understand the process. The market is repeatedly trying to reverse. All triangles contain double tops and double bottoms. We have a double top, and we have a second double top, and we have a double bottom. The market's in breakout mode. 50% chance the market will go up, 50% chance the bear trend will resume down. We have consecutive double tops here, double top, and then another double top. Consecutive double bottoms here, double bottom, and an attempt at a double bottom here, even though we never really reversed up. Double bottom, and this double bottom has a micro double bottom for the first push down. Big bear bar, a second consecutive bear bar. The bulls are giving up, and we're probably going to get at least one more leg down. First leg, pull back, second leg. Strong enough breakout, bulls and bears both agree this price is too high. It has to go lower. Second leg down likely. The bulls who did not sell out here now decide the market's going down. They look for any rally to sell. So the bulls will sell, creating a second leg down. The bears who did not sell initially are looking for any kind of a pullback to sell. They also expect a second leg down. On the rally, bulls and bears are going to sell. Bulls will sell out of their longs. They bought up here. They sell out here with a loss. And the bears will sell as well. Both expect that the price is too high and there'll be at least a second leg down. 3 pushes up, 1, 2, 3, a smaller triangle, and a bear breakout. Strong enough breakout for at least a small second leg down. Here, the second leg down was very small, not profitable for bears who sold here. Different computers see things differently. Some computers will call this an expanding triangle bottom. Even though it's rising, it's still an expanding triangle. First push, second push, third push, or smaller version, first push, second push, third push. Again, it does not matter how you call it. Consecutive double bottoms, we have a double bottom, another double bottom, another double bottom, and each second bottom is slightly higher, so we're getting higher lows, possibly an early bull trend. Triple bottom, 1, 2, 3, or 1, 2, 3. The bulls gave up. The bears tried again to reverse, but a higher low, and then the bulls bought very aggressively up, and the bears gave up. The market was repeatedly trying to go down and failing. At some point, the bulls and bears both agree the price is too low. The market has gone down too far. It probably has to go higher to find where the fair price is, and it did so violently here. Trading ranges always contain double tops and double bottoms. It's in breakout mode. Will the bulls succeed? Will this double bottom lead to a rally? Will the bears succeed? Will this double top lead to a sell-off? Some computers believe the rally is more likely. Other computers believe the trend resumption down is more likely. Once you get a trading range that has 20 or more bars, the probability of a bull breakout becomes the same as the probability of a bear breakout. It's in breakout mode. And you can see when we broke below the double bottom, everyone agreed price was going lower. We have a big breakout bar and a good follow-through bar. Bear trend, a trading range. Every trading range contains some kind of a double bottom and some kind of a double top. We got trend resumption down. The bears overpowered the bulls gave up. Initially, you're looking for a measured move down based upon the height of the double top. Double top, neckline, fell for a measured move down, and there was buying. Bears took partial profits. Bulls may have scaled in, expecting a test of the breakout point. Another trading range, we have a double bottom and a double top, breakout mode. Once it lasts about 20 bars or so, breakout mode, the chance of trend reversal up is the same as trend reversal down. Again, the bears overpowered the bulls, and maybe 2 small legs down, 1 pullback 2. Same process, a double bottom, another double bottom, double top, or double top here and here, breakout mode. Here we got trend resumption down, trend resumption down. Instead, now we're getting trend reversal up. Again, when a pullback grows to 20 or more bars, I start referring to it as a trading range. And when I do that, I'm doing it because I think the probability is no longer in favor of trend resumption down. Initially, this is a bear flag, a pullback in a bear trend. At some point, you have to decide the bears have lost control and it's now neutral. Again, a pullback in a bear trend, but if it grows to enough bars, the probability of trend reversal up becomes almost as high as the probability of trend resumption down. And a third trading range, it's a pullback initially, it's a bear flag, maybe still a bear flag, but at some point, you've got to be thinking that instead of a pullback, maybe it's a trading range. And once you do, you have to be thinking that the probability of a reversal up is about the same as the probability of a resumption of the bear trend down. I began by talking about it's really important to understand that double tops and double bottoms are not perfect, and you have to be very flexible. I then talked about why double tops and double bottoms work. At a double top, for example, the market went up, it tried to reverse. The bull trend resumed, and it might reverse a second time. If it reverses a second time, the bulls who bought at the top of the first leg up will panic and they will sell out of their longs. If enough bulls sell out and enough bears begin shorting, you can get a reversal. If a double top or a double bottom is small and it's within a trend, it's probably a flag, a pullback. The odds are the trend will resume. For example, if you're in a bear trend and you have a rally and the rally is small compared to the bear trend, there's a pullback in that rally and the bulls try again to resume up and they fail a second time, and the pattern is less than 20 bars, chances are it's a double top bear flag and the bear trend will resume. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 2 videos on double tops and bottoms. This is Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 2 videos on double tops and bottoms. I want to begin by talking about how a double top is a test of resistance, a prior high, and a double bottom is a test of support, a prior low. I'll then talk about failure of reversal, a failed double top where the market keeps going higher, or a failed double bottom and the market keeps going lower. And finally, I'll talk about measured moves based upon double tops and double bottoms. Whenever the market does something, it usually has to test what it has done before it decides what to do next. For example, if it's selling off and reverses up, the reversal is usually minor unless there's first a test back down to the original low. Very strong bear trend. The first reversal up is probably minor. The bear trend resumed. The entire pattern is small. This is probably a minor reversal, yet it's still a double bottom. What takes place here is you have bears selling all the way down. Whenever the market's in a strong trend, a breakout, or a very tight channel, the odds are it's going lower. And the odds are the first reversal up will be minor, and the market will have to come back down and test those lows. The bear trend may continue down, or the bears may decide that the rally was so strong that it's no longer a bear trend. Instead, it might be a bull trend or a trading range. The bears were selling all the way down. They're disappointed by this bar. We got a reversal up. Some of the bears sold more here, and when they see these 2 strong bull bars and 3 consecutive bull bars, they decide that maybe the market is going to pull back more. The bears who sold the absolute worst price, this close or that low, then decide that if it gets near their original price, they'll buy back their shorts. And that's what took place here. And you can see the bears gave up and the market rallied. Yet, as strong as this rally is, it's the first reversal up after a strong bear trend. When that's the case, usually the reversal is minor, and the best the bulls get is either a trading range or a bear flag and a resumption of the bear trend. Nobody knows at this point. The bears finally got a chance to resume their trend, but big bear bar, tail, bad follow through, a couple bear bars with tails, and then a bear doji bar. The bulls tried to reverse up, going above that high. It looks like the bears do not have a lot of conviction. There are some bears who sold down here, this low, or even that low, and they did not get out over here because they believed the reversal up was minor, and it may be brief, and the bear trend might continue down within a few bars. They did not want to get out and then worry about how to get back in, so they hold short, stop way up here. The probability is high. Whenever you sell in a strong bear trend, the probability is high that you're going to make money, but the risk-reward is bad. The stop is far away. The bears who did sell this low or that low, if they used a stop up here, did not get stopped out, and they were able to get out around break even, with a profit if they scaled in. If they sold this low and they saw the reversal up, and then they sold more below a bear bar, below this bar, and then get out around their original entry price, they made a profit on the second entry and get out around break even, maybe a small loss on the first entry. Maybe they buy above this reversal up. To take that trade, their risk was great, but by having a bad risk-reward ratio, they got high probability of making a profit or at least avoiding a loss. What traders want to see on the reversal back down is what will happen. Is the reversal down going to be very strong, and will it look like a resumption of the bear trend, or will it be weak and try to reverse up once or even twice at the prior low? The market's testing the prior low. Here, it reversed up. For the bulls to get their reversal, they need a major higher low. They need a pattern that has 10, 20, or more bars. And that's what they have here. This is the potential for a major trend reversal on the test of this low. We don't know yet. Ultimately, it did lead to a reversal of the trend. When the market got down to this price level, the bulls bought. It got down to it again here, they bought again. The bears saw the buying here and they saw the buying here, but they believed the reversal up was minor because it's the first reversal in a strong bear trend. However, they paid a lot of attention to the next leg down. They saw this, all traders saw this sell-off as a test of this price level. Would traders buy again and form a major reversal up, either a trading range or a bull trend, or would the bears break through that level and start a new leg down? You can see they reversed up, second entry buy, first entry above a bear bar after 6 or 7 bear bars. Most traders will not take that. Now they have a second entry buy at the bottom of a trading range, or possibly a major trend reversal, and then they have a bull bar here closing above its midpoint. They will buy above that bar. The bears will get out and the bulls will buy. It's a double bottom slightly higher low major trend reversal. Here's a small double bottom. Traders bought here, the market tried to resume down, and every time it gets to the prior low, it's a test of that low. Will it reverse up again? It did. Again, we're back down to that level where bulls bought before. Will the bears break through that level, or will the bulls buy again? This is a test of the prior low, and it formed a double bottom. Another test of the low, test of this low, and a test of this low. And again, the bulls bought strongly, this time even more strongly than the other times. Very big tail on the bottom of this bar, very big bar. This is a double bottom, a test of the prior low to see if bulls would again buy at that price. It confirms this level as support. It's a double bottom with this low. It broke below the entire trading range and reversed up violently. A lower low major trend reversal, below this low and below that low, after a strong reversal up. Minor reversal, the next leg down led to a major reversal attempt. It failed, and then we have a new breakout, again a test of this low in the bottom of the trading range, and it reversed up even more strongly. Another major trend reversal. It's confirming this area as an important support level. The bulls are overwhelming the bears at this price. The market's repeatedly trying to break below this level and failing. And usually when it does something many times and fails, it then usually tries the opposite direction. It concludes that it cannot get through this level, and this level therefore is probably too low. Next, it has to find a price that's too high. Another test down. Will it break below this low? No, the bulls came in again, forming another double bottom. The bears are losing conviction. Instead of selling at new lows, they're selling rallies, but they're taking profits near the prior low. They're not confident that the bear trend will continue. They're thinking that the bear trend has been replaced by a trading range. And once it's in a trading range, then bulls can try to get a major trend reversal. And the bulls are buying every sell-off, confident that the bulls made money buying here earlier. And again here, they continue to buy there, confident that they'll make money, hoping that they'll make a lot of money. We have a bull trend and then a bear trend. The market turned down here fairly strongly. It broke below the bull trend line, the bull channel. The bulls resumed, and look what happened when it got to this price level. It sold off again, and then it got back there again, and it sold off again. This is an important price level. It's resistance. The market is having a hard time going above this price, and this is confirming the area as resistance, and this is confirming it again. Bulls are buying at every instant on the way up, even at the high of this bar, confident the first reversal down will be minor, and the market will come back up to this level, and they'll be able to get out at least break even. This rally made them whole. The bull who bought the worst price way up here is now whole, and he's probably relieved that he can sell out of his long at break even. When he sees this sell-off, he probably concludes the bull trend is weaker. Maybe the market's in a trading range, and if it's in a trading range, he does not want to be long at the top. He uses the test of the prior high, the test of his entry price, to get out. He sells. Other bulls see this strong reversal down. They know it's minor. However, it's a sign that the bears are strong. They're concerned that the bears may be strong again when it gets up to that level, and the bulls will sell out of their longs, and the bears will sell and take a chance that instead of simply a minor reversal, now we'll get a double top and possibly a major trend reversal. A double top. Does not matter that it's a slightly higher high. In this particular case, this double top is also an expanding triangle. We went up here, turned down higher, and we have a lower low. And therefore, it's a double top, and it's also a higher high major trend reversal. Every expanding triangle top is a higher high major trend reversal. Even without the expanding triangle, it's still a major reversal. We had a very strong minor reversal, followed by a test of the high, and the market found sellers again. This is a double top. It's a higher high major trend reversal. And then we have a slightly lower high, a lower high major trend reversal. The markets are constantly looking for confirmation. It sold off strongly from this level. What will happen if it gets up there again? Will it sell off again? And it did. It increases the probability that you'll get a reversal, or at least an end of the bull trend and a conversion into a trading range. Higher high major trend reversal, probably at least 10 bars, 2 legs down. Leg 1, pull back leg 2. Here we got far more than 10 bars down, and we got far more than 2 legs. 1, 2, 3, 4, 5. strong selling at the new high. The bulls are giving up. You can see they gave up here. And the bears see the bulls giving up, and they're selling as well. Micro double top, up, down, a little bit up, down. Traders will sell below this bull bar, the neckline of this micro double top. And then we have a double top bear flag here. This is also a lower high major trend reversal. A low 2, low 1, low 2. Traders will sell below the low of this bar, taking a chance that we're going to get a swing down. The bull trend needs higher highs, and more importantly, the bull trend needs higher lows, especially major higher lows. A major higher low is a higher low that results in a strong rally, usually to a new high. This is more or less a minor higher low. It has a new rally, but the bars are not all that big. There's not much buying here. This is also a minor higher low. This is a major higher low. The bears tried to reverse strongly. The bulls reversed back up even stronger and got a new high. As long as the market is staying above this low, the bulls will assume the bull trend is intact. But once it falls below that low, bulls and bears will conclude that the bull trend has ended. The market then has either evolved into a trading range or into a bear trend. We have a double top. This is the neckline of the double top. If the market falls below this low, the bears will assume that the bull trend has ended and maybe they'll get a swing down. This is a strong rally to a new high, so it's a very important higher low, and it's also the neckline of this double top. And you can see we got a breakout and a follow-through bar, probably going to fall for about a measured move. The bull trend tried to resume. It tested the breakout point, a little bit above the breakout point, and then reversed down again. That's common to get a breakout below a key support level. The support becomes resistance. The market tests it and then resumes back down. These two bars represent the bulls giving up. They're disappointed and they exited, and they'll wait to buy again lower. And the bears know that. The bears know the bulls will give up below such a strong rally. And the bears will sell below the neckline of this double top. It's a major higher low. And then here, the bull trend's trying to resume. The bears expect at least a second leg down after a 2-bar bear breakout. They'll sell below this bar or below that bear bar. And now we broke above the resistance level, the neckline of the double top. Bears assume the reversal up will fail, and they'll look to sell either below this bear bar, we have a double top here, or below this micro double top. 3 consecutive bull bars. A lot of bears prefer to take a second entry short. So instead of selling below this bear bar, they'll sell below this bear bar. It's a second entry short, double top, test of the neckline. And traders look for a measured move down. We have a double top. The measured move might be based upon the lower of the 2 highs and then the neckline, or it could even be the higher of the 2 highs. Traders will first look at the nearer support level, the measured move based upon the lower high. If it falls below that level, they'll then look at a measured move based upon the higher of the 2 highs and see what the market does there. And you can see, I don't have it drawn in, but this is about the measured move based upon the higher of the 2 highs. A bear trend needs lower lows. More importantly, it needs lower highs, lower major highs. A major high is a high that has a strong sell-off, preferably to a new low. As long as the market's forming major lower highs, it's in a bear trend. If it goes above a major lower high here, maybe here, the bear trend probably has ended, and the market has either evolved into a trading range or reversed into a bull trend. We tried to sell off, a fairly decent sell-off, yet we double bottomed here, slightly lower low double bottom. We tried to reverse up, it failed. We tried to reverse up a second time, and we got 4 consecutive bull bars closing above their midpoints and closing above the neckline of this double bottom. That means most traders conclude that the bear trend has ended, and the market has either evolved into a trading range or into a bull swing or a bull trend. The bears are clearly disappointed. More and more bears are giving up here. And by the end of this bull breakout, bears are definitely disappointed. They expect higher prices, so they'll exit for any reason. They were exiting all the way up. They were giving up during this 4-bar rally. And they'll wait to sell higher, maybe here, maybe here. The bulls see the strong rally, and they see the market breaking above the neckline of the double bottom. The bulls will buy on a stop just above this high, expecting a measured move up, and at least 2 legs up. 1 pullback 2, or 1 pullback 2. Minimum target, a measured move based upon the height of the double bottom. This low slightly below that low. And the market broke strongly above that high, went up to the top of the bear trend. A wedge sell-off, 3 pushes down, spike, pullback, second push, pullback, third or fourth push down, 1, 2, 3. And it's a breakout test, a test of the breakout above the neckline of the double bottom. Good support level. It was resistance. The bulls broke above it. It's support here. And it's support again here. So now we have a double bottom, bull flag. Bull trend, pullback to a double bottom. Bulls will buy the reversal up, especially since it's a wedge double bottom with this low. The market's in a trading range. We have a bull trend and a trading range. We could get trend reversal down. The bears see a double top. We could get trend resumption up. The bulls see a bear channel, bull flag, and then a breakout, and then a pullback to a double bottom. They expect the bull trend to resume up. Anytime the market goes sideways for 20 or more bars, I stop using the term pullback and I begin to use the term trading range. A pullback is a small trading range where you assume the trend will continue. Once the pullback grows to 20 or more bars, I use the term trading range, and when I say that, I mean the probability for trend resumption up is about the same as the probability for trend reversal down. Bulls and bears are balanced. Whenever the market's in a trading range, it always has both a reasonable buy signal and a reasonable sell signal. For the bears, they have a double top. You can call it a slightly lower high major trend reversal, bull trend, bear breakout, testing the old high and trying to reverse down, and a micro double top, up, pull back, up again, maybe a little triangle. It's a sell signal below that inside bar. However, it did not succeed. For the bulls, they see this as a bull flag with a strong reversal up. They'll buy above this bar, or they'll wait for this wedge bull flag, buy above here, or they'll buy above this double bottom bull flag. You can also call it a head and shoulders bottom, left shoulder, head, and then right shoulder, where the right shoulder is a double bottom. Every pattern, no matter how good, fails some of the time, and that includes double tops and double bottoms. We have a double top, this high, that high, this high, that high, and this high, and that high. The bears are trying to get a reversal down. The bears who shorted will put their stops above the double top, somewhere over here. Many choices for a neckline, because most of the time the tops are not exactly at the same level. In any case, this is an obvious neckline. If it breaks above it, the market may rally for a measured move up. The bears expect a double top here and here to fall below the neckline for a measured move down. If it breaks above the double top, traders expect a measured move up. We have a small double bottom here, a bigger double bottom this low and that low. I could also do a measured move based upon this big double top using this neckline for a measured move up. I always look at the nearest target first. This is a trading range within a bigger trading range. If it goes beyond the first target, then I look at higher targets. For example, maybe the market's using this double top neckline for a measured move up. If it goes above that, then I'll look at a double top here and here with this neckline and look at a measured move up there to see what the market does when it gets there. You can see here we have a double top at that measured move and the market's starting to turn down. A good location for the bulls to take at least partial profits. A bear trend, we try to get a reversal, minor reversal. We tested the prior low. Traders are looking for a possible double top. First reversal up, pretty tight channel. Most traders will not buy that. And then we get a second reversal up here or here. They will buy this. But weak entry bar, weak follow through, and then weak follow through all through here. This does not look like it's going to be a successful reversal. And traders therefore will start to wonder if the double bottom will fail and the market will fall for a measured move down. Traders will look to sell on a breakout below the double bottom, and they'll look for a measured move down. They'll sell below that low, looking for a measured move down. We have a pretty good breakout. Probably we'll get a second leg down. We came up and tested the bottom of the double bottom, the breakout point, and we sold off again. We sold off at this price. We tested that price again. We sold off again. Bears will sell below this bear bar as well, looking for a swing down. They'll sell the breakout just below this low on a stop, and then they'll sell the reversal down. Double tops and double bottoms, whether they fail or succeed, often lead to measured moves. The market rallied strongly. The bears tried to resume the small bear trend, and it rallied up again. We have a double bottom. This is the neckline of the double bottom. If it goes above that neckline, traders will look for a measured move up, and they'll use that measured move target as an area to take profits. Good looking buy signal bar, 2 legs down, 1 pullback 2, and a double bottom. Traders will buy on a reversal. They'll buy just above the high of this bull bar and get filled right here. Some traders bought above here and might have held long with a stop below there. Most traders probably would have gotten out below one of these bear bars, and it looks like a lot of traders gave up here. Yet, the market stayed above that low. If traders did exit their longs, they'll buy on the reversal up, betting on a successful double bottom. Here's the measured move. Double bottom, neckline, measured move up. And look what took place there. We reversed down. We reversed down because the bulls who bought for any reason, either here or buying closes or buying a bull flag here or a high 2 bull flag here, leg 1, pullback, leg 2. A lot of them have limit orders to take partial profits here. Others will sell on the reversal down. Micro double top, up, pullback, up again. They'll sell below that bar or maybe sell below these bear bars. Bears know the bulls will take profits, and some bears will sell with limit orders either there or on the reversal down, hoping for at least a scalp down. Double bottom. We have a very deep pullback from this rally, but it held above this low. The bulls see that as bullish. They see this as simply a pullback from this very strong bull breakout, and now we have a double bottom. And they'll buy on the reversal up and look for a measured move up above this neckline. Here's another chart. We have a double top. We have a neckline of the double top here. And how I look at this is this way. We have a strong bull breakout, similar to this. We have a deep pullback, similar to this. Therefore, theoretically, bulls would try to buy here again for a double bottom. Sometimes, instead of getting the double bottom, we get a strong bear breakout. When that happens, I look at it as an attempt at a double bottom. If I see a strong bull breakout like this, and then a reversal below its low, I view it as an attempted double bottom and a failed double bottom, and I look for a measured move down, even though there was not much of an attempt at a double bottom. Strong bull breakout, the bulls should have created a double bottom. They could not create anything like a double bottom. If we fall below this low, I'm going to assume the market will behave as if there was a double bottom and we broke below its low. I'm looking for a measured move down based upon the height of that bull breakout. To me, this is a bull breakout, an attempt at a double bottom. The attempt failed. We broke to the downside. I'm going to look for a measured move down. We have a double bottom. We reversed up to the neckline, yet did not break above it. And now we have a potential double top. Bulls would buy above the reversal up from the prior low, a double bottom. Bears will sell the reversal down from the prior high, a potential double top. Whenever there's both a double bottom and a double top, the market's in a trading range, and trading ranges often have failed breakouts. In fact, most breakouts fail. We tried to break to the downside, we reversed up. We tried to break to the upside, we reversed down. Bear trend, bull breakout, test of the prior low, slightly above the prior low, so a slightly higher low, major trend reversal, not much buying pressure, very tight range, not a high probability buy setup. It rallied to that high, but the rally is weak, reduces the chances we'll get a successful bull breakout, and the bears created a double top. The bulls who bought above here and held long, their stop did not get hit. 3 did not fall below that low. Double top here, and traders who sold here, if they put their stop here, that also did not get hit. This high did not go above that high. So at this point, the bulls theoretically can be still long, and the bears can be short. We have a double bottom with 1 and 5 again. You can call it a double bottom with 3 and 5, 1 and 5. Different computers see it differently. 5 fell slightly below 3. It's hard to see here, but it's closer to the green line here than 3 is here. Yet 5 did not fall below 1. The bulls are still hoping for a higher low major trend reversal and a measured move up based upon the height of this trading range. We broke to the upside to a new high. The bulls are hoping this is a double bottom, a break above the neckline, which is here or here, same price, and they want a measured move up. yet we get a reversal down. The bull's got a breakout above a double top, and it's also the neckline of the double bottom created by 1 and 3. So 1 and 3, this is the neckline. We broke above it, yet the breakout failed. Whenever you have a double top and a breakout that fails, you have 3 pushes up. 1 plus 2 for the double top, and the third push up, the failed breakout. To me, that's a type of wedge. Even though it looks nothing like a wedge, the market 3 times tried to go up and failed 3 times. And therefore, it functions like a wedge. And you have to assume you'll get some kind of a reversal down, maybe a couple legs down. 1 pullback 2, or tight channel, so 1 pullback 2. 3 strong bear bars, 2 closing near their lows. 8 bars down, strong sellers. Probably we're going lower. The bulls tried a bull breakout and failed, and now we're getting an even stronger bear breakout. Chances are it'll be successful. It could be another failed breakout and a reversal up, but after a strong attempt to break to the upside, that failed, and now we have 3 consecutive bear bars. It looks like 8 bars down here. Chances are this reversal up will be simply a pullback from this breakout and a bear flag, and that will go lower. Bears will sell below the bear bar, expecting some kind of a second leg down. In this video, I talked about how a double top is a test of the first top, a test of resistance. A double bottom is a sell-off testing a prior low, a test of support. And that is why the reversals are so often good. The market twice tries to do something and fails. It then tries to go the opposite direction. You get a reversal. All patterns sometimes reverse, and that's true of double tops and bottoms as well. When they do fail, traders look for a measured move. And finally, I talked a little bit about measured moves based upon the height of the double top or the height of the double bottom. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the second of 2 videos on double tops and bottoms.